2026, the market is entering a phase that has occurred only 4 times in the past 50 years. And each time, it wasn't just a correction, it was a complete repricing of all assets. You see, the problem is that most people realize this too late, when the structure of the movement has already changed. Now, right now, the market is going through the first stage of this process. And if you continue to act based on the old logic, you constantly find yourself in a catching up position. In this video, we'll break down exactly how this cycle unfolds and why movements occur in a specific sequence. And most importantly, how to use these mechanics intraday while the majority is still trying to figure out what's happening. At the end, we'll also go over how to structure your approach in these conditions so you don't get caught under the market's main pressure. Every such cycle begins with the same scenario, which at first glance looks like a market mistake. A strong external factor appears, creating an obvious expectations among most participants. In the current situation, that factor is a sharp escalation of tension and rising uncertainty. Under such conditions, it's logical to expect growth in safe haven assets. But the market moves in the opposite direction. And this move happens quickly, without giving time to calmly adapt. This is the moment when most participants lose their bearings, because the usual logic stops working. However, from a market structure perspective, this is not an anomaly. This is the first stage of restructuring. The point is that in such moments, the market reacts not to expectations, but to liquidity, money taken from weak hands. Obvious retail decisions are always visible to large players, and that's exactly where traps are set. You see, when pressure increases, some participants are forced to close positions regardless of their original idea. This accelerates the move and creates momentum against the majority. And it's this momentum that becomes the starting point for the next stage of the cycle. Now, if you look at a short time frame, it may seem like a chaotic movement, but from a broader perspective, it becomes clear that these situations have happened before. First, weaker participants are shaken out. Large capital absorbs their position, and only then does the expected move occur. And this model is fractal. It works the same across all periods and timeframes. Each time after this, the market transitioned into a new behavioral phase. For a trader, what matters most is not the event itself, but the change in price behavior that follows. You see, during those periods, the market starts moving differently than in any calm phases. Moves become sharper and more directional. Pullbacks lose depth and no longer provide the usual counter-trend entry points. The level breakouts start leading to continuation instead of a return to the range. This is a fundamental shift in structure, because in a normal phase, the market often returns to mean values. But in a restructuring phase, it starts moving in impulses. And this is exactly where most traders keep looking for reversals, acting on the old model while the market has already shifted to a new logic. Now, for a trader, this means the need to shift focus, from trying to predict reversal points to working with the direction of the current move, specifically through scenarios where price breaks out of boundaries and continues moving along declining assets, because that's where the main movement is formed. After the market goes through the first stage and a sharp move against expectations forms, a capital redistribution process begins. And this is what defines the structure of all subsequent movements. The first phase has already been covered. It's the movement in commodities and safe haven assets. Now, this is where the initial signals forms, which most people perceive as a breakdown in logic. But this is only the beginning of the cycle. And this is exactly the phase the markets are in right now. Next, the market moves into the second phase, which is related to currency liquidity. At this stage, the dollar typically strengthens as demand for the settlement currency increases. Now, this move is often perceived as a sign of system strength, but in reality, it reflects internal tension. Participants are forced to accumulate liquidity to cover obligations, and this increases pressure on other markets as liquidity is withdrawn from assets. And during this phase, market corrections continue. Then the market transitions into the new third phase, the repricing over real assets. At this point, attention shifts to assets with physical or limited supply. These assets begin to move more consistently and form medium-term trends or stable sideways ranges. These are no longer sharp spikes, but more sustained accumulation. After that, the system moves into the final phase, where liquidity begins to spread more broadly, and a much larger number of participants become involved in the movement. But it's important to understand that by this stage, most of the cycle has already played out. And this is exactly where the majority starts actively entering the market. When the structure has already been formed, at this phase, the markets are ready for recovery. Now, if you compare the current situation to this sequence, it becomes clear that the market is in the early stage of the cycle. The key signals have already appeared. but the next stages have not yet fully unfolded. This means price behavior will remain impulsive and directional. Now, for a trader, this translates into the need to work with the acceleration of a movement, not try to stop it. During such periods, breakout scenarios along the primary downtrend from nearby resistance levels become key, because the main movement forms precisely at the moment price breaks beyond boundaries. Now, at the same time, it's important not to enter during the impulse itself, but to wait for confirmation through price reaction. Most often, this happens through a pullback to the level followed by continuation. This approach allows you to trade in the direction of current market pressure and reduces reliance on trying to predict reversals. Now, the conclusion: if you want to understand how to structure your approach in such conditions and avoid getting caught under the main pressure of the move, pay attention to the live streams on the Pocket Broker channel. There, it's not just the direction that's analyzed, but the logic of each action itself, where to wait, where not to enter, and how to adapt to the current phase of the market. Join if it's important for you, not just to react to movements after the fact, but to understand how to work with them before they become obvious. Links to stream recordings are in the description and pinned materials. Subscribe to the channel and turn on the notifications so you do not miss real-time breakdowns. The main risk in the current situation lies not in the market itself, but in the fact that most people continue to act as if the structure hasn't changed. Now, to sum up, when the sequence of capital movement changes, price behavior changes as well. And if you ignore this, any actions start to lag behind. As a result, a trader constantly ends up in a catching up position. That is why in such periods, what matters is not the number of actions, but understanding where the movement forms and what drives its continuation. This is especially critical in high volatility conditions, where price doesn't give you time to adapt. And without understanding the current phase, the market starts to shake you out of the process. That is why the key task is not to try to predict the market, but to learn to read its behavior in real time. See you soon.